Welcome everyone to our YouTube Live, which we do every 2 weeks. I hope that we'll see more of our supporters, YouTube supporters. I've seen one already. Tim Wright has asked his first question. Before I start answering questions, let me just quickly talk about some of the stuff that we've done recently, which you may find interesting. For Patreon members, we've just posted a video about the benefits of synthetic ETFs, because remember, companies like BlackRock were very much against synthetic ETFs until they were convinced by the fact that withholding tax was much more efficient in terms of being, dividends being passed on to investors. So that's what convinced them that it was actually a good idea to have synthetic ETFs. And in September last year, just a few months ago now, I guess, they launched a big synthetic tracker for the S&P 500, and it seems like they're pretty much behind the idea now. So that video was about why it's more efficient to have synthetic ETFs for UK investors, for example, and for European investors. And then the video for this week, this is going to be released on Saturday, but Patreon members get a preview. They've already got it. I'm going to be talking about QE and the taper tantrum and what could potentially happen once the Fed starts to cut back on stimulus. Because one way to think of it is that it's like having a patient on life support, and you've got to very carefully switch off the life support. And it's often the case that markets have a little bit of a tizzy when that happens, and it causes global disruptions when it does happen. So I talk about the precedent of the taper tantrum, but also when the taper tantrum didn't happen. So there was a case when rates were increasing, but it didn't cause a huge disruption as well. So that might be interesting. I certainly think it's relevant at the moment because we are starting to look forward to this period when the crisis is pretty much past us, and it won't be a return to normal, but it'll be a return to something that's closer to normal. And less lockdowns, more activity, more growth, maybe more inflation, and then the Fed will probably have to certainly cut back on its asset purchases and then eventually raise interest rates. So that could be a bit of a shock for markets. So anyway, that's quite timely, I think. It's certainly worth thinking about these things before they happen and to look back at historic precedents. So let me start with the questions. We're going to be on this call for an hour, so we'll do the usual thing, which is if you do like this and if you share it, that would be great. Tell your friends about it. The sooner the better, because then we can get more people on the call. That would be great. And even if you're watching this afterwards, please do like this video. That would be great, because it helps us a lot and tells other people that it's something you value. So let's start off with a question from one of our YouTube supporters, Tim Wright. So Tim is saying, I'm wondering if you'll do a show on dividend growth investing focused on UK stocks. Generally, I don't talk about dividends or particular dividend stocks, because I guess one way to look at the UK market, one of the attractions has obviously historically been the UK pays a lot in terms of dividends, but in terms of capital growth, it's been abysmal, which kind of illustrates nicely the kind of drawback with that way of looking at things, which is if you're an investor, you don't care where your return comes from, whether it's total return or whether it's dividend, unless it has a tax implication, which for most people it doesn't if it's in a tax efficient wrapper. So if you don't care whether it's dividend or whether it's capital gain, then you should be indifferent as to whether a company reinvests its profits to grow its company's earnings the next year, because that will give you a capital gain, or whether they hand the money to you, which also gives you a gain. And if it's a well-run company, it's slightly worrying that they can't think of a better use of their capital than to give it back to you. If they can't productively invest back into their company, you should be thinking, well, why is that? Perhaps it's a utility, it's not got much scope for growth, perhaps it's saturated its market, but either way, that's not a great story, a great investment story. So, I don't think it's healthy to focus too much on dividends. So I don't think it's likely I'm going to do a show on dividend growth investing. Historically, I have done videos about dividend investing, income investing, because some people do want that. But I think it's probably the wrong way to think about investments. So I don't want to encourage it. So that's probably why I wouldn't do it. But good suggestion. So let's move on. Rui, hi. Nice to see you there. Cecily says, if the government gets the inflation they wanted, how would it affect house prices? So remember, the government only indirectly sets inflation. They tell the central bank what level of inflation they want. Generally, central banks aim for 2%. Now, to get to 2%, we're still quite a way below that in the UK, in the US as well. So if we do get to 2%, I don't think it's going to affect house prices much, because 2% inflation isn't too high. It's what we're kind of used to. And it's only if we get inflation of, say, 4%, 5%, very high inflation or relatively high compared to history, that's going to be a problem. Because at that point, you do start to get the effect, which is to take money out of our pockets, which means households have less disposable income. Less disposable income means less borrowing, and then you can get a lower multiple in terms of the houses you can afford. So less income means greater default rates as well, so banks will be more cautious about lending. So overall, very high inflation, that's 4-5% or more, is going to be bad for the housing market. 2% is a kind of sweet spot for equity markets, for housing markets. Deflation, again, is bad. So it was great that we kind of managed to avoid deflation in the UK, but also in the US, because that would have been abysmal for all investments except for cash and nominal government bonds. So I don't think it's going to be catastrophic if it gets to 2%. I think what's more worrying is a situation with employment. So in the US, we just had the weekly initial claims, which is the number of new people who are newly unemployed, who have lost their jobs and have just filed for unemployment insurance. And it was more than 900,000. I think it was 900,000 new people this last week who applied for that unemployment insurance. So what we're seeing is a very long tail in terms of unemployment. In fact, why don't I just quickly share that with you, because I was quite worried by that. So this is what it looks like. This is unemployment in the US versus the Federal Reserve's estimate of full employment. That's the red line here. So the blue line is the level of unemployment. The kind of yellow bar here is the recession, and then that grey bar over here is the previous recession just after the global financial crisis. So you can see that after the global financial crisis, unemployment reached about 10%, and it took a while to get there. It took about a year to get there, but then there was a very long tail. So people have said that that's because there wasn't enough fiscal stimulus from the government. The Fed had to do everything, the central bank did. This time round, there was a much larger, much more rapid increase. The level of unemployment that we reached was 14.8% in April, but it started to come down very quickly, and everyone was thinking everything was fine. But then, notice what happened. As we got a second spike in infections, we saw the rate of unemployment, the rate at which it was falling, halt. And in fact, in the last employment data that we saw, we actually saw that the US had lost jobs in total. So the US economy has actually got less jobs than it did in the previous month in November. So the worrying thing is that we have very clear evidence of scarring in the economy. And if this thing doesn't get down, it doesn't start decreasing soon, now that we've got the vaccinations, that could be very worrying in terms of the scarring and the long-term impact on the economy. So I think that's a much more worrying thing for the housing market if unemployment stays high. And in the UK, we've also seen the rate of layoffs increase very rapidly. It seems that every week that goes by, we see more companies having to lay off staff. And the furloughs can only go for so long until the government says, no, that's enough, and you're on your own. So I think that's the worry. Unemployment is probably a bigger concern when it comes to house prices. So if that starts to improve, then that could be a positive, as long as we don't see signs of scarring. But as I say, at the moment, it does look like we're going to have some scarring, unfortunately. So back to the questions. Okay, so please do like our stream. That would be great. 57 people have liked us already, but we've got 200 people watching. So only 1 in 4 of you actually like this. Please do like us. That helps us a lot. And let's see. We'll see if we can answer another question. So, some shifty guy, good name, says, with interest rates staying low globally and with Biden in charge, should we reasonably expect global, mostly US equities, to keep rising through the first half of 2021? Yeah, I mean, I saw some jokey emails today saying that there's only been upward movement in the stock market since Biden's been in power. Yeah, but it's only been a few days, of course. But the question is whether the new policies that Biden's come up with are going to be positive for the stock market, I think is what you're saying. And I think it's pretty clear that the answer is yes, overall. Otherwise, we would have seen a sell-off sooner. We've seen a whole spate of executive orders fired off today. I think the one which worries the stock market most is the fact that he said he's going to increase corporate taxes. Because remember, back in 2016, the one thing which Trump did, which was very good for the equity market, was to cut corporate taxes. And that increases the profits companies make, almost by definition, because they pay less tax. And if that's reversed partially, then that's going to be a negative for profits, for earnings, and that's a negative for the equity market. So we'll have to see what happens with that. Biden may be biding his time in order to Biden his time. Yeah. He might be biding his time until he actually does that, because he may be waiting for more signs of economic recovery before he whacks the stock market and tries to rock the boat. Who knows? Maybe that's not the case, but I suspect that's what he'll do. But I think overall, his policies are not negative overall for the equity market. And it's certainly true if you look back historically, Democrats historically have had better returns for what it's worth than Republicans, both for the equity market and for economic growth. So, yeah, I'm not too worried about the Biden presidency and his policies denting the equity market rally. Maybe the other thing that he could do, which people have been talking about, which would hurt the equity market, is try and break up monopolies like Google or maybe even Apple, because they've become like a monoculture, like the old railroad tycoons, or like AT&T, which was also split up because it was too monopolistic and it was stifling competition. Now, if that happens, obviously that's not going to be great for Google, and so much of the S&P 500 is concentrated in just 5 stocks, 6 stocks. About a quarter of it is concentrated in those stocks, and that's quite unusual. So that could be a negative as well. But overall, no, I don't think it's a catastrophe. Certainly not, and I wouldn't be surprised if the rally continues. Right, next question by Michael Pugh. Do you think the 4% safe withdrawal rate holds true for UK equity investors? So what Michael's talking about is the idea with investment is, you save until you retire. And then after you retire, think of it like kind of fattening up the cow. And then after you retire, you slaughter the cow and you gradually eat the meat. So you build up your pension pot until you retire, 65, 67. And then how quickly can you sell the assets such that you don't before you pass away? So that's the name of the game. Now, the rule that people usually say is you can take out 4% of you can sell 4% of your pension pot every year and probably still make it last about 25, 30 years in retirement. It really depends on what happens to returns. The idea is that if the pot is growing by 4% every year, or maybe 5 or 6%, then that's okay. If you're drawing out 4% every year, there's a little bit of leeway. You should be okay in terms of eking out those returns for a long period of time. 4% for a reasonable amount of equity. So I'm assuming you've got very high amounts of equity in your portfolio. It's very unlikely you're going to run out of money if you have a 4% withdrawal rate. If you've saved the maximum amount, which is roughly 1 million for the UK. But it really depends on how much you spend. So as long as you don't have very high expenditure, as long as inflation's not very high, then yeah, 4% is usually enough. Usually not too high a withdrawal rate. It should be okay. But anyway, I've done a whole video about that again for Patreon supporters, where I talked about withdrawal rates and withdrawal strategies. So if you do become a member, Michael, then on Patreon you'll see there's a whole video about it and a document which describes the various approaches.
Member question.
Oh, member question. Oh, is it on Slack? Yeah, here we go. So Talbot Sunbeamer. Hi, Talbot Sunbeamer. Nice to hear from you. USA Schiller Cape ratio exceeded 35 yesterday. Do you think the risks are starting to outweigh any remaining upside? Yeah, I mean, that's an incredibly high Schiller valuation. The other thing to look at is Schiller's new measure, which is his excess Cape yield. And that one actually adjusts the rate of the real interest rates. So what you do is you take the Cape ratio, you flip it. So if it was 35, it would be 1 over 35. And then you subtract the 10-year real rate. And at the moment, that's not looking too bad because real interest rates are so low. So it's actually looking pretty reasonable on that measure. So if real interest rates are fairly low, then yeah, it kind of justifies high valuations. So I wouldn't worry too much about a 35 multiple on Cape as long as real interest rates remain low. The question then becomes, what happens when rates normalize? So if inflation starts to increase or real interest rates start to rise, then suddenly the extremely growth-oriented rally that we've seen, where it's been growth, large cap growth, which is dominated, suddenly looks less attractive because growth depends on cheap borrowing. And if we don't get cheap borrowing, then it could kind of reverse this rally. We've already seen value start to outperform and beat growth, quite often, not continually, but that's been the case since the end of last year. So that tends to happen when markets are pricing in a slight shift. There's been a kind of cyclical rotation so that people are buying small caps. Small caps have done well and values done better than growth. And if it's the case that we start to see interest rates increasing significantly, then that could be a real issue for valuations to normalize again, right? So that's my primary concern. If inflation surprises on the upside, people are assuming inflation is going to be fairly subdued. That could be a negative. If growth surprises on the upside, the Fed's going to have to cut back on its stimulus sooner than expected, maybe fairly aggressively if inflation is very high, or if growth is very high, or if unemployment comes down faster than expected. All of these things could essentially create instability, particularly given that markets are priced pretty much to perfection at the moment. Yeah, I think that could be an issue. But, if rates stay low, kind of okay. Do I follow Jeffrey Gundlach? I think that was a supporter question. I've certainly seen him talk. Interesting guy, interesting ideas, but I don't follow him regularly, I don't think. I mean, it's often the case that members tell me, have a look at what he's just said, because he says interesting things. But no, I don't follow him on a regular basis. Okay. Good evening, Ceramis. Good evening, C. Felipe L. Hola. And nice to see you again, Richard. It's still soggy in Yorkshire. I think wasn't it snowing last time in Yorkshire? Chuck Diesel says, Ramin. Oh dear, lost it. Yeah, here we go. Chuck Diesel says, Ramin, what's up? Hit the like, everyone. Yeah, hit the like, everyone. Yeah, hit the like button. That would be great. If you do hit the like button, obviously it helps us. What's your preferred way to measure cheapness or expensiveness of ETFs, index funds such as Vanguard, emerging markets? With some of these funds, you can't actually get the price to earnings. And so really you have to use a proxy. You have to look at other things. Barclays has some CAPE valuation measures, which it's got for multiple countries. So that's one way to do it. Look at the countries themselves rather than EM as a whole. Most EM indices, equity indices, have China as about half of the index. So probably looking at China is the most important thing. But again, if you look at the top 5 countries, then that'll pretty much tell you which valuations to look at, if you can get those price to earnings ratios. But certainly in emerging markets, I think the bigger risk is that we do get a risk off move in markets, because usually emerging markets sell off more than developed markets. So if you are concerned that things are going to sell off, then emerging markets are probably something best to avoid. If you think that this rally is going to continue, then EM is another thing to think about. And many people I've spoken to over the last month or so, interestingly, many of them technologists, say that they're splitting their portfolio into US equity and Chinese equity. So, Chinese equity as a percentage of global market cap would be about 4 or 5%, but they're increasing that much higher to maybe 10, 20% in some cases. And then the US, they're reducing the overweight. Again, the neutral position for the US would be 55 or 60% because it's such a big market. They've reduced that to say 50 or 40%. So many people are thinking that China now represents an opportunity. It's not as expensive as the US in terms of price to earnings, and many people see a lot of growth there, and they see it as a rival to the US in terms of technological innovation. So, people see opportunities there. Unfortunately, they haven't been able to turn growth into equity market growth as effectively as the US, but there are certain indices which are probably better than others. One of the things to look at is to strip out the state-owned enterprises. If you do that, the returns look a lot better. So things like China Mobile, for example, I believe is a state-owned enterprise. If you go for an ex-state-owned enterprise version of China, that tends to perform better because capital allocation tends to be inefficient for state-run enterprises. They're not really run in the interests of their shareholders. They're probably not as good a way to invest. But yeah, take a look at the historical returns of those indices. There's one from MSCI, for example, and Wisdom Tree has a fund in the US which strips out the state-owned enterprises. I can't remember the ticker of the fund. Maybe some of the people on the call will know it, but that's something to consider. But yeah, valuations, price to earnings, you can use in emerging markets if you can get the data, but it is hard to get the data, unfortunately. Oh, I think we've got a super chat. And it's just
To say thank you.
Oh, just a thank you from Talbot Sunbeam. That's really kind.
And there's
Thank
a
you.
question on the
Oh, and we've got another member question. This time it's a Patreon member. Gary, hello. Isn't it very late there, Gary? I seem to remember you're in the Far East. What are your thoughts on the status quo for the ECB rate change? I'm not aware actually of any changes to the monetary policy from the ECB. To be honest, I haven't been watching that. It's just because I've been so focused on the Fed recently, but the ECB's kind of slipped by. You know, I haven't really, that hasn't really been on my radar. But certainly the rates in Europe being negative has been a problem for some of my clients, for some of the pension crafters, simply because if they have a currency hedge, because rates are negative in Europe and positive in America, it's been a drag on their currency hedge, and it's meant that any currency hedged funds have underperformed. But I can't really comment on that, Gary, because I'm not aware of any recent changes. Yeah, but if you want to ask another question, pop a question, and Laura will flag it for me, and then I can certainly comment on that. Okay. Pedro Aguilar says evening. Good evening. Senko says, what's the best stop loss strategy of a long-term equity investor? The best stop loss strategy is don't sell. I think that's probably the best way to do it. The problem with stop losses is if you do get stopped out of the market, that's not the end of the story. It's not like a game of chess where it ends. That's a quote from Jim O'Shaughnessy. So what happens then, right? So you get stopped out of the market, you've got to find a new entry point. And if equity markets flip back into positive territory very quickly, what are you going to do? You have to find a new point at which to enter. And if you're locked out, then it can be quite unpleasant. That happened to many people in March. You know, they sold after the markets had crashed, and then they watched as markets rallied very quickly and they couldn't get back in, or they had to buy in at a higher price. So probably, you know, having things like stop losses is a bad idea. If you are a long-term investor, the simplest thing to do is to simply buy lots of equity and don't sell it. That's probably the best strategy. So I'd probably avoid things like stop losses altogether. Paul says, will Vanguard provide a synthetic ETF? Very good question. I mean, generally they tend to be more conservative in terms of the funds which they produce. But I think if there was a case that there was better dividend pass through, so if you didn't have to pay withholding tax on US investments, for example, then I wouldn't be surprised if Vanguard did that. I doubt they're kind of I doubt there's any kind of there's not a huge risk to investors. The only additional risk is that you have counterparty risk. So if you have a synthetic swap, what happens is that the fund manager enters a derivative contract with an investment bank or with its own subsidiary in order to be paid the returns on an index. And if that's the case, then let's imagine that the counterparty goes bust. Then you could make a loss on that kind of relationship, on the swap built into the ETF. So that counterparty risk is why the CEO of BlackRock hated synthetic ETFs for so long, Larry Fink. But personally, I wouldn't be surprised if they did that. But they certainly don't at the moment, as far as I'm aware. Vanguard doesn't have any synthetic ETFs at all. Okay. Yep, so do please like our stream. That would be great. About half of you have liked it so far. It would be great if you could like it. That helps us a great deal. And even if you're watching it afterwards, yes, please do like it. It helps us. And then next question from Adam Tarrant. What's your 12-month outlook for markets? Okay. I don't make forecasts, Adam. That's not something I really do. And really, over a 12-month period, you can't forecast markets. But I'll tell you what, I'll give you my 30-year forecast for markets. Okay, so over a 30-year period, equity markets will beat bonds and bonds will beat cash. And that's my 30-year forecast. Generally, emerging markets may do slightly better than developed markets. Some factors will outperform. So, for example, value will probably come back over a 30-year period. Of course, the benefit of a 30-year period is that I'll be dead by the time this comes to happen. So it's very safe making a forecast over that period of time. But although I'm being a bit facetious, my point is that over a 1-year period, forecasts are very unpredictable and very unreliable, and no one can really make 1-year forecasts. Whereas over a much longer period, markets are much more predictable because generally volatility scales as a square root of time, whereas the drift in equity markets from rising earnings increases geometrically. So over a long period of time, what comes to dominate is the drift, and the volatility shrinks, which means that you can be more certain about your forecasts. So I turn that around and say that's the wrong game you're playing. You shouldn't be thinking 1 year ahead. You should be thinking at least 10 years ahead. And if that's the case, then I'd say what's more important is how much equity you've got. And probably just a diversified global fund would do a very good job over that period of time. And it'll cost you very little in fees, which is another way to lose money, guaranteed, is to pay high fees. Okay, move on. Jonathan Ball says, good evening. I was wondering if you think regulation will be a likely theme around cryptocurrency in the Biden era. That's an interesting point. I mean, many people recently have been talking about regulation for cryptocurrency. BlackRock as well, as there was a story today about BlackRock allowing Bitcoin futures in some of its funds. So if there is more widespread use by institutional investors of Bitcoin, it's going to have more regulation, I think. And we also saw the ECB come out and say, Christine Lagarde came out and say that they would have to be more regulated. And so I think that is that is very likely that will have to be more regulation in the cryptocurrency market, maybe more transparency around the people who are actually transacting. And of course, one of the points of Bitcoin was the anonymity and the fact that governments couldn't snoop on transactions. So, it suddenly becomes much less attractive if there is legislation. Suddenly it's not the Wild West anymore and it's becoming more mainstream. And with that, I suspect the attraction and the very high returns that we've been seeing may be less likely. But regulation, I think, is actually pretty likely. Yeah. Michael, I love how Ramin describes this as a call instead of a live stream. Old school cool. Yeah. Yeah, very cool. Gary James says, hi Ramin, what are your thoughts on the status quo for the ECB rate change? Already done that one or didn't? Intelligent eating. Are you concerned at all by the obscene amount of QE and MV being close to flatlined with indices, e.g. the Nasdaq, just pumped on low rates, share buybacks, etc., i.e. a bubble? Yeah. Interesting you should say about the amount of QE, because I mean QE's been great for markets. It's been great for equity, housing, bonds. All of these financial assets have done incredibly well as money's been pumped into the economy. A lot of that money's found its way into asset prices. What it hasn't done is increase inflation much. It's been very bad at that. and that was one of the points I made in this next video. But I think at some point it is going to normalize. It always does. It always has in the past. It always will in the future. And I think many of these bubbly type assets are going to see a fairly unpleasant correction. The EV market, for example, the Tesla valuation, Bitcoin is another. Gold is very sensitive to interest rates. So again, I think gold will suffer if interest rates rise. So I think it will be the case that as things start to normalize, as we get growth back, rates start to rise, the Fed starts to cut back on its stimulus and eventually starts to raise rates, we're going to be seeing a very different market. So normalization of valuations, the things like the CAPE ratio will come back into line with longer term averages. So yeah, I think there's going to be a lot of fairly big shifts in the market. So it's best to be ready for that. How can you prepare for it? Well, you can look at historical precedents. That's why I talk about the past so much, because we have seen these patterns repeat themselves so much in the past. But I think that's all you can really do. Just look at what happened in the past and try and make some kind of inference about how to position your portfolio to kind of weather those changes, because the past does repeat. It's not perfect, the repetition, but it is. We do see things from the past kind of repeat in the present. So just be aware of that history. Don't just have a very short-term view of markets where you just look at the returns over the last decade and assume that's always going to be the case. We won't always see 12% returns on average on the S&P 500, for example. Oh, we've got a super chat. Pedro Montano, nice to see you again. I think you have asked a question before, Pedro. He says, I have a stock ISA with Vanguard and Nutmeg. Both give me exposure to the S&P 500, but nothing on Nasdaq. True. How can I buy a cheap Nasdaq index with an ISA? Okay, so they do exist, but Vanguard doesn't offer one, a Nasdaq fund. In the US, Vanguard has a tech fund, VT, but Vanguard in the UK doesn't, unfortunately. There is a small cap, global small cap fund, but not a tech fund. So if you want that, you're not going to be able to get it from Vanguard. There's one from iShares. There's a QQQ tracker. So there's a NASDAQ tracker that's available from iShares. And that's done incredibly well over the last decade, particularly in sterling, because as sterling has weakened, that's increased the value of the assets in dollars. So it's actually done better than the NASDAQ once you denominate it in sterling. As sterling strengthens, of course, the opposite's true. It's been a drag on performance. But there is I think the NASDAQ tracker from iShares, from memory, I think the annual fee is 0.3%. And it's beaten a lot of the very large UK active funds. So it's beaten Fundsmith hands down, like by a huge margin over that decade, over the last decade. It's beaten many of these very large active managers in the UK. So it's very easy to get as long as you're not with Vanguard. So you just yet another thing that's annoying about Vanguard, unfortunately. Right. Right, next question. So do like us, that would be great. We've got 320 viewers and 200 likes, which is great. But if you do like us, it helps us a lot, so please do like the stream. And yeah, so C. Felipe L says Dixie to 100 in the next month. So Dixie, if you're not aware of it, is the dollar index, and it's the dollar versus a kind of basket of currency. So let me just quickly share my screen again, but I'm going to show you this fund, which is, let me just share that. Yeah, so you can see share scope here. This is this it's not the Dixie, but it is the strength of the dollar versus a basket of other developed market currencies who trade a lot with the US. So it's a trade weighted basket. And what you can see over the last 2 years is generally strengthening in 2018 as the US generally grew faster than the rest of the world. But then in April 2020, after the dollar appreciated massively during the big risk-off sell-off, as generally equity markets have powered ahead, the amount of risk appetite in the markets has just gone crazy. Everybody wants to buy any kind of risk. And because the dollar is a safe haven, the dollar's weakened a lot. Plus, everybody is pretty much at a zero interest rate now, so the interest rate differentials aren't there. With greater risk appetite, the US dollar's sold off. But I don't know if you can see, it seems to have stabilized at the beginning of 2020. So I don't see a lot of downside for the dollar from here because the interest rate differentials are pretty much, zero. We're all at pretty much zero now. And risk appetite, if you look at global equity markets, with the incredible rally that we had last year, seems to be kind of slowing down. But if that continues, I could see further downside for the dollar, but I think it's unlikely that it will. So I'd expect lower returns in 2021, less risk appetite, and maybe a kind of more choppy recovery. But I don't think there's a lot more downside for things like Dixie or UUP. So back to...
It's members' question and there's requests for Ted.
We've got a TED request. Right.
Members' question.
Members' question first. Okay. And the members' question is, Stephen O'Keefe, hi. If stock returns beat other asset classes in the long term, and you're a long-term pension investor, would you hold 100% global equity portfolio or further diversify into fixed income and real assets? I mean, generally, if you look historically, fixed income for things like treasuries, so this is safe government bonds, has almost always had lower returns than equity. So if you have almost any equity, if you have almost any bonds in your portfolio to replace the equity, it produces a slight drag on returns. So diversifying into lower returning assets is maybe not the way to go. But if you do have a very long-term investment horizon, then investing in fixed income such as emerging market government bonds or things like something like high yield credit in the US, it's mostly a US market, or maybe even in Europe, because you can do the same thing as you can with equity, which is to look through the volatility, as long as you don't do crazy stuff like sell in a crisis, then long term, that form of more risky fixed income could also give you a higher long-term return. It won't provide such good diversification as government bonds. So if you have an equity market sell-off, junk bonds sell off as well. Emerging market government debt sells off as well. But as long as you have control over your emotions and you don't sell when that happens, if instead you buy, then you'll probably get a good outcome. But if you are going to go into fixed income over a longer period of time, you probably want to take more risk, either by taking more duration risk, so go further out on the yield curve, but just be aware that you're taking more inflation risk that way, because inflation affects long-term bonds much more. Or think about more credit risk, because again, you can look through the volatility and you can look through these crises if that's your mindset. So I'd say, and then in terms of real assets, I think the difficulty with some real assets, and here we're talking about things like, you might be talking about things like commodities, so like gold. Gold is a good long-term diversifier, but if interest rates start to rise significantly, gold's not great. Things like land, is some people think a good investment, but again, that's very illiquid. And generally, you have to invest a large proportion of your portfolio into land or property. And if you're talking about commercial real estate, then there are other issues, because we've seen a lot of societal changes due to the pandemic, things like less office space usage, or commercial property, things like shopping centres, or shopping malls as they're called in the United States. Not so popular because people are moving to online retail. And a lot of the catalyst for change that's come from the pandemic is running against those assets. So you've just got to be careful to look at these long-term trends. And I'd also avoid illiquidity. I don't like any market which is illiquid. You should get a big premium for investing in that kind of market, which you often don't. So yeah, I think real assets, less attractive, but certainly for the fixed income side, yeah, consider something which is higher risk, which people don't usually tend to do. Now let me just get some snacks for Ted. Here we go. Here we have his dietary approved snacks. Oh, he's suddenly powered up. He's sleeping under Laura's feet. So here we go, Ted. Now you're going to do some nice tricks. You're going to stand up. Oh, very good. Are you going to stand? Oh, very good. Good boy. One more? No, he's still eating. You going to have one more? One more snack? Or he hasn't finished that one. It takes him a while to chew these. They're quite big. I don't know if you can see that. Ted, you going to stand? Are you going to rest on me? That's so lazy. Stand. Oh, Teddy. Thank you. There we go. Something for everyone. Right. Okay. So do like the stream. Teddy insists on it, don't you, Ted? You can ask people. Yes. Please like the stream. Otherwise the dog gets it. No. 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 Oh, he's found the treat bag. I don't want to have him there. Down you go. Yeah. Okay, so next question. Oh, that's an interesting one. Okay, so Jonathan Ball's got an interesting one. Question from Dashcam Sam, first of all. Is it time to go all in on crypto? No. Jonathan Ball, when determining which investment to choose, do you know when I should use a net present value or internal rate of return as the better indicator? I mean, generally internal rate of return is backward looking, whereas net present value is forward looking, where you've got some kind of discount factor on future cash flows. You have to guess the cash flows, but generally, if you use, I mean, the best models I know, and there's an off the shelf spreadsheet come from Aswath Damodaran. I mentioned him 2 weeks ago. I mentioned him again. Aswath Damodaran. Go to damodaran.com and you can download the spreadsheet for free. And it's a great way to learn about investment. He's got videos on YouTube. It's just impossible to improve on that. So I think, just probably use one of those spreadsheets. Okay, next question. Joey. Hey Ramin, investing in musical artists' songs has been in the news recently. Wondered if you had any thoughts on it, potentially even as a hedge against stocks and bonds. That's really interesting. I mean, a lot of artists have actually started. Teddy was just burping, sorry. A lot of artists have taken their future revenue from their existing catalogue of songs and they've securitized it. In other words, all of the future cash flows from those songs are sold as a bond to investors, which means today they get a big lump sum, which is the present value roughly of all their future cash flows. So is that a good deal? I guess for some artists, yeah. I mean, imagine that you could have bought Bowie bonds. At the time, David Bowie, I think, was the first person to do this. He securitized his future payments from his music. But imagine, that's probably still generating revenue today. The danger is that you go for an artist which starts to fade. I mean, not many people listen to many of the artists that. So if you look at all the artists who are around today, how many of them will still be popular in 10 years' time or in 20 years' time? But certain artists really break the mold when it comes to popularity, and their music's almost timeless. I mean, I'm a big fan of Bach, and that was written 400 years ago. So it's quite unusual to get composers like that, or artists whose music is just so good that people would still listen to it in 100 years' time. But they do exist. But my point is that it's very difficult to know who those are ahead of time. So that would be my concern, that the music would fade from popularity. There wouldn't be any new material in the catalogue, or that they'd just be a one-hit wonder, or their style of music would no longer be popular. One of the things I listen to, which is kind of interesting, is on this theme, is the Jim O'Shaughnessy Infinite Loops podcast. And recently he had this guy who was a specialist in hip-hop music, but not in the music itself, although he knew a lot about it, but in how it makes money. And I mean, obviously hip-hop is still popular now. It's been around for a while, I guess over a decade. But the worry would be that hip-hop suddenly isn't cool anymore. And that would be a worry for me. But anyway, do listen to that podcast because it was really interesting. I mean, I'm not an expert on hip hop. I'm not sure I could even name a hip hop song, but the interview itself was fascinating, and the guy was really interesting. It's worth a listen. Okay. Adam Tarrant very kindly says your content on Patreon is well worth the sub. That's really kind of you. Thank you, Adam. And let's move down the questions. I'll put Tiddy Snacks away. Intelligent Eating says, I just see the Western world heavily pregnant economically with absolute hell-spawn triplets. Interesting. Right. Oh, Ian Davies says, I thought they were expecting 935k. I guess you're talking about the initial claims number. So it was better than expected, so it's not so bad. Well, 1 million people out of work every week. I mean, there's no way you could spin that as a good thing. It's pretty clear that there's really a big problem in the US in terms of employment at the moment and unemployment. And it is a lot harder to get rid of unemployment now that it's got to this stage, this deep into the crisis, this far into the crisis. Okay. So can you please explain your opinion to US small cap? And if you prefer the Russell 2000, more quantity, more junk, or the S&P 600, more quality? Yeah, I guess in this kind of environment, everybody's buying. You could call this a dash to trash rally, where everything is rallying and the quality or the valuations is kind of ignored. So in this kind of environment, I guess something like the Russell 2000 would perhaps outperform. It's hard to say. My personal preference would be for the S&P 600 because of the quality aspect. But you can buy things like, maybe it's going to be a comeback for small cap value. Maybe you want to look at something like a factor added to small cap, or something like Jim O'Shaughnessy stuff, which is to look at micro caps and to combine it with something like momentum and maybe value. But yeah, I mean, I don't have a strong opinion about either of those. My personal preference, as I say, would be to go for quality, because at some point, if we do see a return to more natural or kind of more normal valuation, or people caring about valuation, then small cap value might be the way to go. because that'll sell off less than small cap without value. Right. Chris Farland says, I think I'm going to wait until the stimulus ends before I invest any more into my 80/20 life strategy fund. Your thoughts? Well, I did a whole video about holding back money based on valuation, and the kind of conclusion for that was you can't really time it very well, at least not using the valuation measure I looked at, which was Shiller's excess cape yield. Historically, that simply hasn't been a good indicator of when to hold money back. But if you do that, then the threshold where it worked best was a value of excess cape yield was lower than 6. That meant equity markets were expensive in the US, and that was the time to hold money back. But currently we're not there. So we're not expensive according to that measure. So I wouldn't be holding back based on that empirical analysis. Whether that holds true in the future, who knows? But certainly that's been the case historically. So yeah, usually it's best not to hold back anyway. It's best to just continue investing, use an asset allocation you're comfortable with, have as much equity as you can, and just stick with it. Don't try and time markets because it doesn't usually work.
Member question.
Oh, member question. Is that Tim Wright?
It's Gary.
Oh, Gary. Okay. Question from Gary. Okay. Do you see significant signs of economic recovery in the UK, EU, or US? Yeah, I mean, we've had big employment gains in all of those. Big employment gains in the US. In the EU, I guess the economic growth, certainly in terms of the economic impact, the UK has probably been hardest hit and it's taking longer for us to recover. The EU somewhere between the UK and the US. And then China is the one that's come out of it best in terms of economic growth. It was never that much impacted in the first place, if you believe their figures. So, but there are definitely signs of recovery. The trouble is that we've entered a kind of second lockdown in the UK, which is going to have a drag on activity. Just as things were starting to improve, we got this new variant of the virus, which is more contagious, and we've gone into a second lockdown, which is going to be a drag on growth. So I think we're going to have a second dip in the recovery. But once we get the vaccine, I'm fairly confident that things will start to improve fairly quickly. And certainly equity markets are pricing that in. So let's hope it does happen. But there's very clear signs of economic improvement. If you look at the US GDP numbers, if you look at the UK, we did see, after the initial shock, we've seen a fairly big bounce back. But we're still not to the level that we were at before the crisis. That's what you should be really looking for. And that might take a while, particularly if the unemployment situation doesn't improve quickly, which is why this long tail of unemployment that we're seeing in the US is very worrying, and in Europe as well. And also in Europe, we've got the worry of deflation, which is very much a matter of concern. The central bank, you can see from their comments that they're also very concerned about that. And they'll probably have to end up doing more in terms of stimulus in order to counteract deflation if it hangs around for longer. But there are signs of improvement, definitely. Yeah. Okay, let's move on. Please do like us. We've got 352 current viewers, 356, 260 likes. So please do like us if you're watching.
2 minutes.
And we have 2 minutes to go. My goodness, I wasn't keeping track of time very well. And remember, if you do become a patron, we get this kind of call, but with far fewer people, about 50 of us. So I generally get through all of the questions, not always, but often. There's a much higher chance of you having your question answered, and you get to join us on Slack where you can ask questions all the time. So let's just do one more question. So I'll choose very carefully. And okay. So, question from Marek. which is what's your opinion about investing in gold instead of buying stocks? Well, again, for members, there's a gold valuation spreadsheet, and that's a very simple model. I certainly wouldn't trade on the back of it, but what it does suggest is that gold is currently 20% undervalued. The reason why I say that is because real interest rates are low. That pushes up gold. The dollar's weak. We've already seen that. And that's good for gold because it's priced in dollars. So according to that model, gold should be about 20% above where it is today. So yeah, I think gold at the moment, tactically, over a short-term period, certainly looks attractive. While interest rates remain low and while markets remain pretty much complacent, that could be a nice little hedge, and you're getting it fairly cheap based on that kind of valuation model. So yeah, gold is something to consider. But of course, on Vanguard, you can't buy it. So you have to have a broker where you can buy gold. But anyway, let me wrap it up there. Remember, you can always join us as a member. You can now support us on YouTube. There's a join button underneath our videos. And then you get your little crown next to your name with PensionCraft. And you'll notice we answer your questions first. And also you can do a power hour with me, one-to-one, and we can discuss things. I don't give advice. I simply act as a sounding board for your investments. Or we can talk about general principles or any of the things we've discussed on this call in more detail. So thank you all for joining us. It's been great to have you on the YouTube live, not the call. And see you in 2 weeks' time. Thank you all, and see you then.